Congratulations and welcome to your final topic in Applied Company Law. In this podcast, we'll be looking forward to your brilliant futures, and if you're thinking of becoming an auditor, what are the rules and regulations you need to comply with? So for this, we're at Chapter 20 of your textbook. The Corporations Act sets out requirements for who can become an auditor. Let's start with why auditors are so important. Auditing is an important way of evaluating the effectiveness of a company's internal controls, which is vital to achieve a company's business objectives. How can a company run smoothly if auditors aren't there to provide financial reporting on its operations, prevent fraud and stealing companies' assets, and minimize costs of capital? All companies are required to keep financial records, but not all companies need to produce independently audited annual financial statements. Only public company, large companies and company limited by guarantees are required to do so under Sections 292 and 301, subsection 1. Who can be an auditor? There are some registration prerequisites in being an auditor, and an auditor can be an individual person, a firm of auditors, or a company under Section 324 AA. Auditors must be registered with ASIC, and it is an offence to work without being registered under Section 324BA to 324BC. Significantly for US students, in order to become qualified for registration as an auditor, as well as graduating from university, you must have completed courses in audit and company law, which is this subject, applied company law. Just as importantly, Section 1292 sets out all the ways an auditor can have their registration revoked, including professional misconduct or failing to perform their duties or maintaining continuous registration. Under Section 329, an auditor can be removed from their position by resolution at a general meeting, as long as the auditor has had the opportunity to have their say and defend themselves and have had 2 months' notice of the meeting. Or an auditor can voluntarily resign, but only after they have first written to ASIC outlining the reasons why they are resigning and ASIC has consented. So what does an auditor actually do? The primary role of an auditor under the Corporations Act is to verify that financial information disclosed by the company under the requirements of the Act correctly reflects the state of the company's accounts. So an auditor's role involves A. Evaluating the sufficiency of the financial records, and B. Checking financial reports before they're published against the financial records. Under Section 307, an auditor must form an opinion about a number of matters, including whether the company's annual financial report complies with accounting standards, or has the company maintained proper records and registers, and then the auditor must report this to members about the financial report under Section 308. In order to form an opinion, the auditor under Section 310 has the statutory right of access at all reasonable times to the books of a company. They can reasonably require information, explanations, or any other assistance of any officer of the company. What are the auditor's obligations and duties? Auditors have a number of statutory duties, which include reporting on any breaches of the Corporations Act by the company or its directors and officers to ASIC. Another big statutory duty of the auditor is to remain independent, and they must give their clients a declaration of independence under Section 307C. This is to remove any conflict of interest. For example, a conflict of interest could be where the auditor of a company is also a shareholder of the company. Why on earth would the auditor want to form a negative opinion about the company, saying that it has kept bad financial records, which would impact the share price for the auditor as a shareholder? Or what if the auditor's best friend or wife was a director of the company? They are getting preferential treatment as auditor over other potentially hired auditors to give a good opinion about the financial report. So you can see that auditor independence is very important. Like lawyers or doctors or any professional who gives advice, if an auditor is negligent and provides incorrect or misleading financial advice or breaks their statutory duties, they can be sued by their client. There are two main areas this arises in: breach under contract and negligence. The first is contract. When auditors are engaged by a company, they enter into an employment contract with the company that sets out all the terms of their appointments and duties. If they break one of these terms, then the client can sue for breach of contract. The second is in negligence, and this is where the auditor is negligent in performing their work. Maybe they miscalculate figures or approved a report that was financially incorrect. When an auditor is negligent, this causes pure economic loss. The leading case for when a client sues their audit company is Daniels and Anderson, the AWA case, which you learnt about in Director's Duty. Remember, the Forex manager hid losses in the millions and the directors sued the audit company, blaming them for failing to pick up on the financial losses? In this case, the court agreed and found the auditors were negligent because they knew but did not immediately report the internal deficiencies to the company, resulting in loss. So that concludes our podcast about auditors, how to become an auditor, and an auditor's rights, duties, and obligations. Remember, the law takes the role of the auditor very seriously because they're the gatekeeper for the company, protecting the company from financial losses.